Hey traders and investors, it's Serge Berger here. Today we're going to talk about how to actively manage your risk a little bit more prudently in a bear market, or at least in a more volatile market. So we're going to look at the Russell 2000 here, and the main point to make, really, to get right to it, is that when you're talking about a more volatile market from an active trader point of view, you want to do several things. First of all, you want to reduce your position size. You want to raise cash levels. Of course, that's something one would have had to do long before the current levels, since support levels have been broken. But even now, don't just start piling into new long positions, or 10, 15 different stocks. Keep it tight. Keep it to a 2, 3, maybe 4 positions at the most, just so you can kind of, your emotions don't take over and start making you do things that you don't want to do. Plus, when it gets more volatile, it's just more difficult to keep track of things. Additionally, what's been working over the past few years is just basically buying the dips as we found support somewhere near the major moving averages, trend lines, and classic oversold levels. What we're now thinking, what's going to happen, I discussed this in yesterday's video, is that we're going to see a heightened volatility environment. Not so much a high volatility environment, but just a heightened volatility environment where the VIX maybe finds support somewhere near the 15 area as opposed to the 10 area, which is sort of the historic lows. So just a higher floor for the VIX. What that also means, you got to start working in different time frames again. So don't just look at the daily charts or the weekly charts anymore. Now you really got to start working from a trader perspective, just for perspective, not so much for trading purposes. In other words, not just so that you have to start day trading, but just for perspective, start looking at some of the near-term charts, like a 15-minute chart. Here you can see at the very moment, for example, we got stochastics starting to get overbought. We're still below the previous resistance line that I just drew on the daily chart, but you can also see that we're starting to break out of a mini resistance market. All those kind of things can start giving you a little bit more perspective to manage your risk. And this business always is about managing risk, but it's particularly important to manage your risk in a market that's more volatile, because A, you get chopped around, and B, when you get chopped around, we tend to make bad decisions from a trading perspective. So I hope this made sense, guys. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.